Yo, welcome back everybody to the Doggy Yaps channel. And today we're going to be talking about when inflation cools, the East starts to build. And I know I haven't been making videos for the past 2 weeks because I just got back from vacation and I've honestly had a very pretty busy stuff going on in my personal life. I've been working on a lot of side projects for you guys to test out with Pulu Quants and Pulu Labs, and I've just gotten a new job, and it's been taking some time to get used to, and that's how it goes. But so where we're at, Bitcoin is sitting at around 64,000 big buckaroos, and just saying, guys, this might be the bottom. You never know, but this could be the bottom. And the Bitcoin network is roughly worth about $1.9 trillion. And the reason why I wanted to make this video today is because the bigger environment is starting to change in front of our own eyes, right? So inflation has cooled from the May spike, and the Fed is starting to hold rates quite high. And long-term borrowing costs are being elevated in real time. And at the same time, capital markets are starting to move on chain. So this does not make Bitcoin. This is not a Bitcoin price video, right? This is about what happens when the price of money starts to change, and while the rails for the new financial system are being built right underneath it in front of our own eyes, because Bitcoin is still the scarce monetary asset. But this is a much bigger conversation around it, like liquidity, debt, tokenization, institutions, and where capital starts to go next. So CPI changes liquidity. So let's make CPI simple here. CPI is the consumer price index. It tells us how fast the cost of everyday living is starting to rise. So food, rent, gas, insurance, everything normal people need to buy. The latest report showed that the headline CPI at 3.5% year over year. So that is down from May's 4.2%, which is quite a drastic change, to be honest. And core CPI, which removes food and energy, was about 2.6%. That is genuinely meaningful improvement. So Warsh is actually doing his job. But this doesn't mean that prices are starting to suddenly become cheap again. It means that prices are still rising, just slower than they were before. And that matters here because the Federal Reserve watches inflation before it decides whether money can become cheaper. And if inflation keeps cooling, the Fed gets more room, they get more wiggle room to eventually lower the rates. And if inflation turns back up, the Fed may hold the rates higher for longer. Right now, the Fed's policy rate is still between 3.5% and 3.75%, which higher rates means borrowing cost is more, and which equals that people spend less, businesses borrow less, and investors take less risk. And less risk taking means less liquidity flowing into risk assets like Bitcoin and the whole crypto market itself. And but the markets begin to expect easier money. Bitcoin can also be one of the first places that liquidity returns. So why does Bitcoin care here? CPI is just not, a one-day headline. It literally determines the price of money. And the price of money determines the liquidity environment Bitcoin tends to be traded in. So the East goes on chain. While America is locked in on the Fed, inflation, and interest rates, the East is starting to build the rails for on-chain finance. And this is not just about crypto speculation, right? It's literally about it's not about another token launch. It's literally about moving from real world assets on chain, right? So we get bonds, real estate, funds, corporate securities, stable coins, and eventually a bigger part of a global financial system. So Japan is a great example here. So Progmat, Japan's largest tokenized securities platform, has started to move more than 2 billion in tokenized real estate and corporate bonds onto dedicated Avalanche infrastructure. So that means that the regulated financial assets are being moved onto the blockchain rails, and not only because people want a new buzzword, but because the new existing financial system is quite slow, and settlement genuinely starts to take time. Markets close. Um, Moving money across borders is quite expensive, and there are literally middlemen everywhere. And tokenization is about making the financial ownership easier to verify, easier to transfer, and easier to settle. and it is making capital programmable. And when major financial systems start to experiment with this at scale, the question starts to change. It stops being is the blockchain real, and becomes more, which assets move on chain first. And Bitcoin was the original proof that value can be digitally scarce, globally transferable, and settled without a bank man in the middle. So, here to my analogy is, think about this. Like, new technology wins when it becomes infrastructure, faster, safer, and cheaper, and eventually invisible. And think about it like cars. Most people did not see a car and it immediately goes, oh, that is the obvious future. They saw something loud, weird, expensive, and probably really dangerous for how fast it went. And horses already worked, so why would we need something new, right? That was the system that most people understood. So why trust a totally new machine? But over time, cars got faster, they became safer, more affordable, and the roads got built. Then the gas stations got built. The supply chains got built. And entire industries were being built around this new technology. And eventually, nobody cared about the engine. They instead cared about if the car got them to where they needed to get to faster and more efficiently. And that is how infrastructure gets adopted. So people do not love the new technology. They just need to realize that it works better, and that's how I think about the blockchain. Most people will not wake up saying like they love tokenization because they don't understand it, right? Most people, they don't even understand cars or motorcycles or anything, but they still use it day to day. They'll same with, like, on-chain finance. They will start to use on-chain finance because the settlement is faster, because ownership is easier to verify, and because value can be moved without less friction. So Bitcoin was the first car. It showed the world that a digital native asset could be scarce, verifiable, and owned without permission. And that brings me to my slide where Solana is infrastructure. So Bitcoin is digital scarcity, and Solana is the high-speed programmable infrastructure. Different jobs, one on-chain shift, right? So this is where people can create a fake argument. They say Bitcoin versus Solana, but they are not trying to do the same job. They are two different things. Bitcoin is the monetary asset. Bitcoin is digital scarcity. It has no CEO. It has no earnings report. It has no central issuer. No committee that can decide to create more supply. But Solana is the infrastructure. It is trying to provide fast, cheap, programmable rails for trading, payments, tokenized assets, and financial applications. And that does not mean that every Solana project tends to win. It definitely does not mean that every token deserves your money. But it does mean that the market is testing whether open blockchain rails can support real financial activity at scale. So Solana can be expanding block capacity, payments, tokenized asset activity, and its status page currently shows normal network operations. So when people ask, why does Solana matter if Bitcoin exists? That itself is the wrong question, because Bitcoin is a scarce asset. It is the monetary asset, like I said. And Solana is an example of the rails where capital and digital assets can move. So they don't need to be the same. They don't need to be enemies. Bitcoin proved that digital value could exist without a bank. Networks like Solana are testing how financial activity can be built on those kinds of rails. So the more people understand on-chain ownership and open settlement, the easier it is to understand the breakthrough that Bitcoin introduced first. So Warsh is at a crossroad. The Fed credibility meets debt financing pressure, and the Treasury needs buyers. The bond market gets the final vote. So let's bring this back to the Fed. Kevin Warsh is standing at a crossroad here, and he became Fed chair in May, and his early challenge coming into his term was credibility. He needs markets to believe that the Fed is serious about inflation, and that why he just can't walk out and promise easy money, because inflation is still above the Fed's 2% target. So the public message has to be inflation is not fully defeated. But there is another side to the story. So the US is carrying an enormous $40 trillion amount of debt. And when rates stay high, refinancing that debt becomes more expensive, right? Old debt matures, new debt gets issued at a higher rate, and the government interest bill tends to increase. So the system has pressure coming from both sides, and the Fed wants credibility, but the Treasury needs buyers. So the government wants manageable borrowing costs, and the bond market gets the final vote. So Bitcoin exists outside of that system. It is not debt. It is not something. It is not someone else's liability, and its supply does not rise when the system needs relief. So the bond market decides. So the Fed controls short-term treasury rates, but then the bond market decides what the long-term money costs. And the 10-year here is about 6.8%, and the 30-year is about 5.2%. So the 10-year affects mortgages, auto loans, business loans, commercial real estate, and the general cost of borrowing across the economy. And the 30-year is the long-term confidence check. If it is the market's vote on inflation, debt, deficits, and future growth, and whether investors are being paid enough to lend money for 3 decades. So even if the Fed cuts short-term rates, that doesn't automatically mean that money gets cheap. It If long-term yields stay elevated, borrowing still stays expensive, and the economy remains to get tight. And the financial pressure keeps on building. And that is why you can't only watch for what the Fed says. You have to watch what the bond market does. And the bond market tells you whether liquidity is actually getting easier or whether the financial system is still under stress. So when the bond market hits crypto, crypto can sell off first when money tightens and move first when the markets expect conditions to ease. So this is where the bond story becomes a Bitcoin and crypto story. When yields remain high, borrowing gets more expensive across the whole economy, right? Mortgages stay expensive, businesses financing stays expensive, risk capital tends to get more expensive. And when money is expensive, investors pull from the furthest out risk. This is why Bitcoin always gets hit first. Bitcoin is liquid, it trades around the clock, it is easy to sell. So when the markets need to de-risk, Bitcoin can be one of the first assets that people tend to sell. Then these altcoins get hit even harder. But the opposite is also true. The latter is true. If inflation keeps cooling, if the Fed gets more room, if long-term yields finally start to come down, the price of money changes as well. Capital starts looking for returns again. And Bitcoin is usually the first major crypto asset institutions tend to understand. It has the clearest monetary thesis, the deepest liquidity, and the strongest institutional access. So Bitcoin can get sold first during these liquidity squeezes, but it can also be the first scarce asset capital buys when liquidity environment tends to return. And what we're starting to see is that the AI trade is starting to get crowded, right? Right now, the market's favorite trade is AI and chips, data centers, energy, compute, and every company trying to position itself as an AI winner. And to be clear, AI is real. Like it will change business, it will change software, and it will change how people work. And most of these companies won't be AI companies. They'll just be companies that use AI, right? Like it's like the 2000 like .com bust. Everyone was an internet company, but now everyone's just an online business. It's just business online. Same thing with AI. And but markets don't need like but markets do not pay you just because something is real. Markets pay you when the future turns out better than what investors already expected. And expectations around AI are enormous. It's supposed to change our lifetime. It's one of the biggest changes we'll ever have in our lifetime. So eventually markets ask one question. Where are the returns? Not if AI is the future. But did investors pay too much money for that future today? If that question gets louder, capital does not need to disappear. It can rotate. And it can search for the next opportunity that is not fully priced in. I'm not saying that every dollar leaving AI flows into Bitcoin. That's not how markets work. But when the most crowded trade begins to lose its momentum, like how AI is losing momentum now, investors look for a new home. Like they look for new capital, right? And Bitcoin is global, liquid, scarce asset. When capital rotates, scarcity can become interesting again. And we have here on the screen where on the left is the Korean stock market, and almost 50% of it was like, I'm pretty sure it was like Samsung, and they were they were literally memory chips, right? And you can see that the funding on the right has been starting to get tighter, and hyperscaler AI infrastructure capex is starting to, like, here, like, it's starting to rise, and that ain't a good thing, man. That ain't a good thing. So let's do a little quick AI update. So Kimi K3 and DeepSeek is challenging the scarcity and the pricing of frontier intelligence. And on so Kimi K3 is a language model by Moonshot, which is an AI lab, and they just released a new model that is low-key destroying these frontier models. You can see here on the left, look at this. The code arena, the full stack coding benchmark. Kimi K3 came out on top of Fable 5, on top of GPT-6 Soul. Here as well on the right, front end web app benchmark, like to make the front end of web apps. Kimi K3 came on top, bro. Fucking nuts, man. And the bigger question is not whether AI works, right? It's because it obviously does. The question is who captures the profits as frontier models AI becomes more competitive and more accessible. New models like Kimi K3 have pushed the market to ask whether the biggest AI valuations can hold if capable models become cheaper to build and to use. That doesn't mean AI is dead. That means that the AI trade is becoming more competitive. And when a trade becomes more competitive, markets start repricing who wins and who loses. Now look at Bitcoin. While AI is fighting over valuation and margins, Bitcoin's institutional pipeline is still being built. Spot Bitcoin ETFs gave traditional investors a familiar way to get Bitcoin exposure. Advisors can allocate, funds can allocate, institutions can access Bitcoin without learning private keys on day one. And we have recently seen renewed ETF demand. US spot Bitcoin ETF saw about 360 million in net inflows on August 4th, just today. So that doesn't mean that flows go only in one direction. They will reverse. Bitcoin will stay volatile as it is. But then the important part is that the reals are starting to exist. Large pools of capital now have direct exposure into Bitcoin. And that changes the demand side, not only the supply side. So institutions can build products around Bitcoin. They can buy it, they can sell it, but they can't print more of it. But they can't even vote to make the 20 million cap higher. So more access, more potential demand, same fixed supply. So, dude, my slides are getting cooked here, man. So this is the institutional pipeline I was talking about with the ETFs. And here is a quick clip of the man Fink talking about tokenizing assets. Let me play this quick clip for you guys.
Joining us now exclusively here at Post 9 is the company's chairman and CEO, Larry Fink. Larry, good to have you here. Thank you for being here.
Carl, David.
And Jim will probably ask some questions as well, no doubt about that. I guess, it seems as though things are working on all.
To our systematic equity, our AI-based equity region, it was a completeness. And I think it comes down to the whole portfolio, the entirety of a conversation. When we bought, there's...
It's very loud here.
It is very loud.
But it's good. Capital's at work, Larry. You like that.
I love capital at work.
Yeah.
But there's $4.1 trillion of money in globally in digital wallets. A lot of that money is outside the United States. If we could tokenize a ETF, digitize that ETF, we could have investors who are just beginning to, invest in markets through, let's say, crypto, they're investing in it, but now we could get them into the more traditional long-term retirement products. So we look at that as the next wave of opportunity for BlackRock over the next tens of years, as we start moving away from traditional financial assets by repotting them in a digital manner, and then having people stay in that digital ecosystem. They can have their cash, and we have the largest cash money market fund that's tokenized called BITL.
So there's the man Fink talking about tokenized assets, right? The man himself, that is the CEO of BlackRock, is talking about tokenized assets. $4.3 trillion he's talking about. And the Bitcoin market cap is 1.29 trillion. Just heads up, guys. So the main thing that I'm watching is, first is inflation. And the next CPI report comes out on August 12th. And I will make a video about that. And I want to know whether the June slowdown was the beginning of a real trend or just one better report. So the second one is the bond market. Watch the 10-year, watch the 30-year. If yields stay elevated, financial conditions may remain tight. Third is ETF flows. Are institutions actually allocating capital, or are we just reacting to short-term headlines? Fourth, tokenization, not press releases, not companies putting the word on blockchain on the slides. I want real assets issued on chain, real settlement, real users, real adoption, because that is when it stops becoming a narrative and becomes more infrastructure. Then you have to watch inflation, watch the bond market, watch ETF outflows. And the thing that Bitcoin is, it's still scarce monetary asset that is still sitting in the middle of the shift. And we got to prepare, guys. And I want to talk about a little Pulu update. This is what I've been building, guys. Pulu Quants is a platform where you can connect your LLMs to trade the capital markets. And we've released live hyperliquid trading to where before we were only locked into Aster because Aster was the only DEX that we were connected to. And now we are live on hyperliquid. So whether you use Aster or hyperliquid, you can use both. Like you can access Pulu Quants. Like your LLMs can access the whole capital market, right? Whatever DEX you use, your agents can use them on Pulu Quants. So if you want to support me, I'm not asking you to, buy this, buy that. You can support me by subscribing, liking, commenting what you want to see next, and using my products. By using Pulu Quants, helping me build this platform a lot better, and a lot better for you guys, right? Because your input matters, because you are the ones who will use it, and you are the ones that will profit off of it, and you guys will be the ones who lose on it. And the goal here is to make a platform that that these big institutions have hidden behind these huge paywalls, and give it to you guys, because we all know, dude, these asset managers already have AI managing positions, right? And we want that ourselves. So yeah, if you want to use Pulu Quants, it is in the link in the description. It'll mean a lot to me if you guys use it, and let me know what you guys think, because I think it's a cool product, man. I've been using it myself for almost 6 months, and it's actually been quite good. Have actually gotten some pretty decent returns here. So yeah, and Pulu, like I said, is something that I've been building around connecting AI and large language models with capital markets. And the point isn't to hand AI your money and hope it works, right? The point is to give people more structure, to filter information, to monitor conditions, and to track market changes. And this define risk rules instead of emotional decision making. Because the thing with AI is, with trading capital markets, you have to be connected to your desk. You have to be glued to your phone whenever you're trying to do something. And these LLMs can decipher this information a lot faster than us humans can. And this gives us opportunity and gives us our time back, basically. And time is the only other thing that is truly scarce to human beings. So yeah, we've expanded to Hyperliquid, and yeah, hopefully you guys love it. If you guys don't, let me know what you guys don't love about it. And yeah, so conviction is built here. Conviction is built in the drawdowns. DCA intentionally, protect your runway, and separate headlines from the thesis. Right? Because conviction isn't built when Bitcoin is at its all-time highs. Conviction is built right here at the bottom at bear markets, when headlines are mixed, when yields are high, when people are bored, when people get nervous, right? When the market makes you question whether you believed it a few months ago. Everybody says they want to buy Bitcoin lower, but when the volatility actually shows up, it never feels easy. Nobody knows the exact bottom, right? Not even me. Not even dude, nobody knows the exact bottom. Like nobody can time every candle. But you can learn the asset, you can understand the macro, and you can avoid taking risk that you can't afford. And you can build your own long-term conviction. Watch inflation, watch the yields, watch the flows. And I have two memes here. And on the left, we have this Zadomi, where he just stacks stats and holds. And this guy, the trader, where he does technical analysis, on-chain metrics, charts, trading and timing the market. And you can see he's stressed. He's tripping, bro. And you have this guy, just, the Robin Hood guy, just the chill dude. He just stacks stats and holds. And on the right, we have when Bitcoin tends to get it at all-time highs, everybody wants a piece of the pie. Everybody wants to buy sats. But when it gets, and everyone goes, oh, when it gets to 60K, I'll buy. When it gets to 80K, I'll buy. But then here we are at 60K. Like, why are people lining up? Like these are the prices that you were dreaming of, like when Bitcoin was at its all-time highs. Just a little heads up, guys. So DCA with intention. It is important to stack sats. It is important to start building in the bear market. And yeah, that's all I have for you guys. I hope you guys enjoyed this video, and I'll continue making them if y'all enjoy it. Once we get a bigger enough community, we'll start doing this live and have more fun together and have Q&A and be able to talk and have a chat. So like, subscribe, and comment what other Bitcoin topics you're interested in. And see you in the next one. Keep stacking your sats. Don't forget, this is where conviction is built. I'll see you guys in the next one. Ciao.